You think staking is free yield, but staking plus gas fees and token inflation can underperform just holding Bitcoin. The surprise is that the APR you're quoted can be the least important number in the whole trade. Here's the setup. A protocol advertises 12% staking rewards. Your wallet shows new tokens arriving every day, and it feels like you're being paid for patience. But real return is what you can buy after all the hidden leak points. First leak: gas and operational friction. If you stake on-chain, you often pay to approve, stake, claim, restake, and eventually unstake. Even if each action seems small, it adds up, and it's usually paid in the network's base asset, not in the token you're earning. That means your yield can start by subtracting a fixed cost that hurts smaller portfolios the most. Second leak: inflation. Many staking systems pay rewards by minting new tokens. If supply expands 10% a year and you earn 12%, your advantage over non-stakers is closer to 2% before fees, slippage, and taxes. And if you're in a liquid staking token or a rebasing token, it can feel like your balance is growing while your share of the total network barely improves. Now the tension: price risk and unlock risk. Staking often comes with lockups, unbonding periods, or delayed withdrawals. If the token drops 30% during your lock, a 12% APR doesn't rescue the outcome. And if volatility spikes, the inability to exit becomes its own cost, because your capital is trapped while other opportunities appear. Deeper layer: dilution can be invisible when everyone is earning. If most holders stake, the protocol may be paying everyone from the same inflation pool, so the market price adjusts to the extra supply over time. Your staking rewards can become more like treading water than compounding wealth. Meanwhile, Bitcoin has no staking, but it also has no inflation schedule that expands supply each year beyond its issuance curve. And there's no unbonding queue to access your coins. Payoff. The correct question isn't, what's the APR? It's, after gas, after inflation, after lockup risk, and after price volatility, did my purchasing power beat the alternative? A simple test is to track your position in a harder unit. Compare your staked token value versus Bitcoin over the same period. If your token balance rises, but its value in Bitcoin falls, the staking rewards were a distraction, not a strategy. If your balance is growing, but your share of real value is shrinking, are you earning yield or paying an invisible fee? Subscribe for more clear, numbers-first breakdowns of crypto returns before the hype does the math for you.